A home equity reverse mortgage, or a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older. Its unique features make the HECM a valuable tool in retirement planning and aging in place. Many people are surprised to find that in this day of increasing gray divorce, that a HECM can also help in this truly tough circumstances. We're going to review this flexible product in a few circumstances in which we think it can help. Here are a few examples of how a HECM can help in a divorce. HECMs are very helpful in splitting the family home among divorcees where the partners could not otherwise afford to separate, or where one of the spouses wishes to stay in the home and pay off the leaving partner. Or due to the separation, one or both of the partners have diminished income but wish to maintain their same but separate standards of home occupancy. The lower qualifying requirements of a HECM and the ability not to make a monthly payment, either temporarily or over the life of the entire loan, many times makes the difference between affording a home or having to rent. While it was not actually intended as a primary purpose, it is clear that one potential area where a HECM can help is with late-in-life divorces. The program's lower income requirements, the option of making or not making monthly payments, and the government insurance that guarantees no deficits upon sale of collateral or guarantees life in-home payments makes HECMs a viable option for those involved in gray divorce. One particular feature is extremely helpful. To qualify for a HECM, savings or investments can be dissipated or spread over the remaining life of the borrower and considered as income to help qualify. In a forward mortgage, underwriters consider only the dividend or interest yield on the asset as income. This cash flow interpretation can be essential for a divorced borrower to help qualify for a mortgage. Let's take a few circumstances and compare a HECM to a traditional forward mortgage loan. Where one of the parties has to take a mortgage in their name, the underwriting requirements for forward loans are much tougher than those for a HECM. Especially on the income and credit elements, HECMs permit a lower qualification standard and credit scores are not considered. Bear in mind that on a HECM, depending on the age of the borrower, a down payment will generally be higher on a HECM than a forward loan. So borrowers, if refinancing, should sometimes have as much as 50% equity in their home. The down payment declines to 25% as borrowers get older. Some circumstances have the spouse paying a mortgage and relying on receipt of a steady alimony check to do so. Lenders will consider proven alimony as income to qualify. The issue is more personal. What if the alimony stops for any reason? A HECM provides an optional payment feature that essentially permits the homeowner to stay in the home and not make any mortgage payments at all over the course of the loan until the loan is called due and payable. HECM loans are generally called due and payable when the borrower permanently leaves the home. Of course, property taxes and insurance and necessary repairs do need to be made. Where alimony is needed to qualify for a home purchase, the use of a HECM permits more flexible underwriting terms than a forward mortgage. Voluntary alimony payments in the last 12 months can be used with a HECM to help qualify. And in circumstances where the ex-spouse paying the alimony may have their dreams of buying a similar home impacted due to lower income levels, the use of a HECM can mitigate the loss of that income. So you can see in these limited examples that a HECM can be very helpful in a divorce where one of the parties is age 62 or older. Let's look at some examples. He's age 75, she's age 62. They are divorcing. They both work. They both have Social Security of around $2,000 each a month. They own a home worth $500,000 with no debt. They got $100,000 in the bank. They're splitting the assets 50-50, and they want to sell the existing home and get their own new homes. They both likely have enough income in Social Security to pay taxes and insurance on their new homes and meet the minimum residual income requirement under a HECM. Their income, however, would not be enough to get a traditional forward mortgage and meet the amortizing payments. Let's assume they want to replace the home with a similar value. Because of different ages, they can get differing HECM amounts. The wife, being younger and who will live longer, gets a HECM that is smaller than her ex-husband's on the same home value. She needs to put in more cash than he does. But if you'll note, they end up with the same equity and cash overall, but with different cash amounts. The important thing to remember here is that they get the same level home they wanted with no required monthly mortgage payments. In our second example, it's the same couple, but she wants the current house and he wants to be paid off. If you look carefully, you will notice that they end up in the same equity and cash position overall. But she can take a HECM out and pay her husband the $250,000 share. Her cash out after she's paid him is $12,000, plus she keeps the $50,000 in savings. In this example, a HECM permitted her to stay in place and for him to exit the circumstances. So what is a HECM? Well, it is a loan. It's debt on your principal residence. You do have to pay it back when the last borrower leaves the home. And as with any mortgage, you have to pay the taxes and insurance or face possible foreclosure. You don't sell your home to the lender, though. And it is an optional repayment loan. You can decide not to make a monthly repayment or make no repayments at all. Your credit is not impacted. You will never owe more than the lower of the value of your home or the balance of the mortgage. It is a non-recourse mortgage. You can access your money in a variety of ways, such as a line of credit or a guaranteed annuity like monthly payment. If you have a line of credit, any unused balance on that line of credit will grow monthly at the current interest and insurance rate. It can at times exceed the original value of your home. And any equity left in the home is yours and can be bequeathed to your heirs. So how is a HECM different than a conventional reverse mortgage? Well, under the HECM program, the property values are limited to a maximum of $636,150 for the purposes of calculating the gross loan amount. This does not mean that your home is not worth $1 million or more. It just means that for the purposes of calculating the dollar that we will lend you, this is the maximum appraised value we will attribute to your home. As we've discussed, the unused line of credit can grow, and it's a full non-recourse loan. But there are important other features, one of them being the non-borrowing spouse protection. In the past, non-borrowing spouses may have been asked to leave the home if the borrowing spouse had died or passed away. Now, non-borrowing spouses are protected, provided they're qualified and disclosed at the origination of the loan. Also be aware that all of the funding and the program mechanics are guaranteed by the U.S. government. This is important if you're going to live 30 years or longer, and you want to know that the U.S. government is standing behind all the lenders who owe you the money and can make you the payments. And finally, FHA lenders are required to help with any tax and insurance defaults. If you temporarily get behind, they can advance the money, even if you do not have it available on your HECM, to pay the tax and insurance and other property charges. Of course, you have to pay them back, and the pay period usually is between 1 and 3 years, depending on the size of the advance. If you fail to pay them back, or you go delinquent again on property taxes while the advance is outstanding, you can possibly find yourself in foreclosure. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.